Literally hundreds of people every year that are turning 65 and getting ready to retire who have absolutely no idea that Medicare isn't free. That couple right now in 2018, age 65, would need a combined total of $280,000 just to pay for their healthcare costs in retirement.
Welcome to the Inside Forbes Council's podcast. Each episode shares transformative insights and advice from members of Forbes Councils, a group of invitation-only communities for successful executives and entrepreneurs. This is Inside Forbes Councils.
Hi everyone, and welcome to episode 14 of the Inside Forbes Councils podcast. I'm your producer, Stephen Ganoza. Here in the US, healthcare costs are rising. Insurance premiums keep going up, and for those younger people in the workforce, it's something that's going to continue going up in all likelihood for the next 30 or 40 years. Absent some amazing technological breakthrough that defeats aging, we're all going to get old, and odds are going to incur medical costs later in life and in retirement. At first glance, it seems like a problem so distant and so insurmountable, maybe it's not even worth thinking about. That's probably not the best idea. There's a fair chance these expenses are waiting out there in the future. But the good news is, we can plan for them. Danielle Roberts.
Hi, I'm Danielle Kunkle Roberts. I am the co-founder here at Boomer Benefits, and we are a licensed insurance agency that operates in 47 states. We help baby boomers navigate their entry into Medicare, help them learn how Medicare works, what it covers, what it doesn't, how it operates, and then we assist them in finding supplemental coverage and drug coverage to fill in the gaps for the things that Medicare doesn't cover.
But before we might discuss how to save for healthcare costs in retirement 30 or 40 years from now, let's take a look at the retirement landscape today.
Today's landscape for retirement is really even a lot different than it was 15 and 20 years ago. You have people that are living longer, and this is something our medical technology takes us into later and later stages of life these days. On top of that, you have people who then work longer because they're healthier longer, they're able to work longer, sometimes they need to work longer. And the thing that's probably changed things the most is, of course, the advent of the internet. So before, you might have had many people all retiring kind of on time, right at age 65. And the big change, the big dynamic that's different now is that people don't have to retire at 65 because there's so many jobs that are not physical or manual labor anymore. You have people being able to work part-time. You have people being able to start their own business. And they can have these encore careers that are completely different than maybe what they were doing before. And they're generally in fields where there is no age limit. So if you have an Etsy page that you've started, or you're selling your services on Amazon or eBay or Fiverr, you can do this type of job right from your home, and you could probably work in that industry until 85 or 90 or longer that you would want to work. So that whole retirement landscape has completely changed from, we used to work for these big corporate giants and we had a nice pension and we would come out of that and have healthcare provided by them, to now people often work in smaller companies or they work for themselves after they have left their jobs. And unfortunately, those encore careers don't come with healthcare retirement benefits. So we don't see a whole lot of retiree coverage these days. A lot of the big corporations have started getting rid of that. So when you turn 65 now, Medicare is going to be your primary insurance. It's a national health insurance program, and it's something that's completely unfamiliar to you. So this is where we see so many people end up being unprepared.
So many people are unprepared for retirement. But retirement is something that people have known about for 30 or 40 years. How then are so many caught unprepared?
So I think the lack of preparedness comes from a number of things. First and foremost, throughout our working years in most industries, we have FICA taxes deducted from our paycheck. And we see that little deduction on our payroll stub. And we know that it's being pulled out and that part of that goes to pay for Medicare. And Medicare is sort of this big unknown entity out there that we know nothing about, but we assume that that payroll deduction is taking care of that. And so we meet literally hundreds of people every year that are turning 65 and getting ready to retire who have absolutely no idea that Medicare isn't free. So the FICA taxes are part of the issue, but also the idea of a national health insurance program. People think of this as something that covers 100%. So they think about, our people up next door neighbors up there in Canada, they don't pay anything for their health care. They don't have copays at the doctor. There's no such things as deductibles. And people hear this throughout their lifetime. And so they tend to think that when they get to the US's national health insurance program for people age 65 and older, that this little bit that they've paid throughout their working lives is enough. And they don't expect that they're going to have the same kind of deductibles and copays and coinsurance on their Medicare as they have all their working life in their group health insurance that's been provided by employers. And so I really think that those things kind of snowball and contribute to a general lack of information, early enough to make any changes. If you don't tend to look at what Medicare is going to be about until the day that you're turning 65 or the 6 months before, and as people, we procrastinate, you don't want to think about Medicare at age 50, or maybe you think right now that Medicare won't be around when you're age 65. And so when it comes to that time and you realize, oh my goodness, I have not saved enough to pay for healthcare in my retirement, it can be really a rude awakening.
A financial plan for retirement has to anticipate healthcare costs. So what can a financial planner advise their clients to do today?
I think that financial planners can really help with this conversation by starting the healthcare piece of it earlier. So lots of people out there have a financial planner, and we work through things like how much money are we going to need to pay our rent? How much tax deferrals are we getting right now so that we have a larger nest egg? What kind of lifestyle do we expect to lead when we are in retirement? And of course, all those things are very important to plan for. But I've read some statistics about that sometimes for a financial planner to have a conversation with their client about healthcare can feel a little bit uncomfortable. We're talking about, pieces of information that might be protected by HIPAA law. And it can be a little bit of a conversation that maybe some planners tend to steer away from. But I do find that this group of people, and people in my generation and also your baby boomer generation that are aging into Medicare right now, they are open to statistics. And so if we provide some of the information about how much you need for healthcare in retirement, you're obviously going to provide that earlier than them finding out at age 65 that Medicare is not free. So I think I saw Fidelity, I think it was on one of the Fidelity websites, that a couple right now in 2018, age 65, would need a combined total of $280,000 just to pay for their healthcare costs in retirement. And yes, as Americans, we need to save more and we need to save longer. But sometimes we don't anticipate that right now our health is good, or that our health may not be so good as we age. Things stop working and we need to have eyeglasses, and there's all sorts of things that we anticipate, but then we don't anticipate that maybe we develop a chronic illness or we have developed cancer, and these things can wipe out your healthcare savings very quickly. So we need to plan for the base amount of money, which I already think is more than people plan for, but then you also need to think about that you may not be so healthy tomorrow as you are today. And so if you got to retirement with this figure that you've worked out with your financial planner, hopefully, and then you had a healthcare event that was completely unexpected, where are we going to turn for that extra money? Those are a couple of things that I think financial planners can do to really educate people ahead of time and letting them know how much that they need to be putting together. One of the tips that I would have for financial planners as well is to make use of health savings accounts. So I do a whole lot of consulting for employer groups around the nation. We do webinars for employees, and we talk to them about what Medicare is going to bring, what are the things that we need to be prepared for, and how Medicare works. And in those conversations, it seems like over and over again, we meet businesses that one of their healthcare options is a high deductible, consumer-driven health plan that also has a health savings account attached to it. I meet tons of people that have an option for a plan like this. And those are really something great that I think financial planners could recommend for their clients, because of course, the planner is going to like the part about the tax deferral, and the money that you put in your health savings account is going to be tax-free. It's not going to go on your income taxes right now. But what really is going to happen is that retiree is putting away money in a medical nest egg that they think of differently than the rest of their funds. So in their mind, it's a separate pool of money. And we know that down the line, they can only take that money out for medical costs, dental costs, vision costs. You can also use that money to pay for Medicare premiums. So that premium that people are not expecting, right now it's $134 a month for Part B. And if you're a high income earner, it might cost you as much as $428 a month. So you're talking about a significant monthly expense. And any money that you can put in that health savings account now, when you're over 55, you can put an extra $1,000 a year in there. And that money that you save now is then money that you can take with you into your retirement. You can use it for the things that you weren't expecting, the gaps in Medicare, the deductibles, the copays, the coinsurance, but you can also use it to pay some of your Medicare premiums. So I think that planners educating people on what those are and letting them know that if they have that option at the place that they're working, or if they're buying their own insurance through the Affordable Care Act and the healthcare exchange, they can buy plans that give them that money, the opportunity to put into a health savings account, which can be a separate nest egg for them later that's completely aside from what they've put together for their lifestyle expenses.
$280,000. Have you got that money set aside? We'll take a quick break while you tally up how much money you've got set aside for healthcare costs.
Are you a successful executive or entrepreneur with insights to share? Learn more about our invitation-only communities at ForbesCouncils.com. Forbes Councils members have the opportunity to collaborate with fellow business leaders to overcome challenges and create new opportunities. Members also have access to support benefits that help them save time and money, and a platform, Community Voice, on Forbes.com, through which they can amplify their voices and exchange ideas. See if you qualify at ForbesCouncils.com.
Danielle Roberts of Boomer Benefits is helping us wrap our heads around the looming cost of healthcare in retirement. Come to think of it, I don't think my wife and I have a healthcare savings account.
And not everybody will have access to one, but it seems like the more and more employers that have contacted me, even some really large corporations, most of these companies give their employees an option to choose from 1 or 2 or 3 different health plans. And 9 times out of 10, we're seeing one of those options being one of those consumer-driven, high deductible plans where the person has the option to open the health savings account. As a married couple, you can contribute over $6,000 a year into those things these days. And then on top of that, the extra $1,000 that you can do for the catch-up contribution, if you planned it right and you were contributing to that account for a good 10 years before you go on Medicare, you could literally have, 6 figures in that account ready to be used when you need it later on when you're retiree.
Younger people in their 20s and 30s often have a lot of other expenses, such as student loans, or are just not earning a high income yet. Is this something that they really need to think about?
A good timeline for your younger generation, and I even think about this with millennials. I've got quite a few of them working here for me today. Part of what they run into is they don't think that Medicare and Social Security will be around for them. So it's something they actually don't do a lot of thinking about. But even in my own age range, which is 45, my financial planner has never had a conversation with me about healthcare costs in retirement. And so I really see that this is something wide open that a lot of people could miss. But we know that over time, the money that we set aside compounds. And we also know that typically when we're younger, we are usually a little more open to having a higher deductible, right? Because we're immortal. Nothing's going to happen to us. We're great. Those dreaded illnesses and infirmities are still a few decades away. And so we find that a lot of people in those younger groups actually do purchase those high deductible health plans. And so the first step is just to investigate whether you are in a health plan that offers you a health savings account. So we offer one here at our agency, and I was very surprised to see how many of the younger group of people enrolled in that health plan. But I also noticed that they weren't setting up the health savings account. They just wanted the cheapest possible insurance in case they fall down on their skateboard and break a leg or something. So we want to investigate first whether you have an option for a health savings account. And we know that over time, the money that you put in there is going to have compound interest. And so you might be able to put in a much smaller amount now, and then someday have quite a big, large nest egg for all of those expenses that we just talked about. I really think that conversation does need to be had with your financial planner or on your own. If you're doing this on your own, you do need to start thinking about it in your 30s, because when you get to say 50 or 55 and you realize these things about how much Medicare is going to cost, it really may be too late for the total amount that you need. And we see a lot of people of the caregiver age. So people of my generation, your Generation X, we're just now starting to take care of our parents who are aging in 65, 70, 75, depending on where you fall in there. And we're starting to sometimes help our parents with some of the decisions about Medicare and our healthcare. And so we learn a little bit right now about, wow, look at what mom has to pay for her health insurance. I didn't realize that it was going to be this expensive. And that can be the light bulb moment where you say to yourself, hey, I'm going to be in this same situation here before not too long. And what am I doing to make sure that I've got a certain amount of money set aside somewhere where I won't touch it or break into it, that's just going to be designated for those healthcare costs? Because even if I'm totally healthy, I'm looking at premiums that I'm going to pay every month. I've got to pay for a drug plan. I'm going to have copays for my prescriptions. And then Medicare only covers about 80% of my expenses. So if I need a knee replacement and that surgery costs $80,000, where am I going to come up with that other 20%? And those are the kind of questions we need to think about and realize that, we aren't so immortal. We're not invincible. Our day will come and we need to plan for it.
Healthcare costs are often not transparent, and because billing usually goes through insurance companies, consumers rarely know the actual cost of a procedure. How then can you project expenses when the cost of services is not exactly opaque?
It is difficult to do projections for something that might be needed 30 years out. And we know that the cost of healthcare and long-term care as well is something that inflates at a crazy pace. When I have this discussion with clients, and often I'm working with baby boomers and their adult children, and then this leads into a conversation with the adult child about, wow, I need to be putting away some money. How do I know what I need to? I know there are some online calculators that you can use to adjust for inflation. So if we were to take that Fidelity figure of a couple needing $280,000, the one thing that I think is in our favor is that Medicare sets the rates. So the cost of a knee replacement that we would go have right now at a normal hospital would be much more expensive than if we were running that through Medicare and they say, well, that's how much it costs, but we're going to set it at this. So there's a Medicare allowed rate that is heavily discounted to protect the federal government from overspending for healthcare. So even if you took the figures that are there today, if you said right now I need to have $280,000 for healthcare and retirement, and this is the number that I'm going to go after, that money that you're setting aside in whatever account you're doing your financial planning with is going to also be accounting for some adjustments and increases in your investments. You're going to earn interest on that stuff. So considering that we don't save enough as it is, I usually say to my clients, even if we put this figure down that we need to put away for our retirement, it's going to be better than if we had just ignored this problem or didn't know about it. And we know that Medicare is also going to be keeping somewhat pace with the increasing inflation. So if something costs $10,000, Medicare probably pays about $2,000 for it. And that protects you also, since you're going to be paying 20% of those allowed amounts. That inflation is somewhat kept up with by Medicare. I just think the main thing is that people need to get a start on it. And even if your figure and your projection isn't correct or perfect, it's better for you to be trying to hit a number and have something there than to have nothing. And that's really what we see so often. I mean, we have so many people that I meet that are aging into Medicare and they're living just on Social Security. And there's tons of stats out there that planners can share with people and probably do on a regular basis about, 50% of couples have, 90% of their income is Social Security provided. And that's just never enough. It's not enough for people to pay rent. And so we have these conversations sometimes with, I can't afford my medicine because I got to make my rent payment. I won't eat groceries this month. And so we tend to see people erring on that far end of that scale. And I guess that makes me think something is better than nothing. But for the people that are making these plans and sitting down early enough and putting together a financial plan, add on something for your healthcare as well. And you want to think of that money as separate, and it's money that you can't touch because you are going to need it someday and you may be less healthy than you think. So start with a figure and go after it and do it as early as possible. And this is wisdom that you've heard from dozens of investment sites and financial planners all over the world, but it really is the right advice.
Boomers, millennials, Gen Zers, there's likely a bill in your future for at least $280,000. Maybe it's time to talk to your financial planner about healthcare costs in retirement, or reach out to somebody like Danielle Roberts of Boomer Benefits.
You can find us online at boomerbenefits.com. That's our website where you can find hundreds of pages of information about how much Medicare costs, what it covers, what it doesn't cover, what type of supplemental insurance you can purchase to help you fill in the gaps. That's a great place to find us. You can also connect with us on Twitter, where our handle is @BoomerBenefits. And you can find us on Facebook, where we have a great page with over 55,000 fans. A lot of fun Medicare information to excite you.
So as you make your selections this open enrollment season, consider your plan for healthcare costs in retirement. I want to thank Danielle Roberts of Boomer Benefits for sharing her insights, and we'll see you on the next episode.
This has been Inside Forbes Councils. Please be sure to subscribe to us on iTunes, Spotify, or wherever you get your podcasts. If you're a member of the Forbes Councils and would like to participate in our podcast series, please email your member concierge. If you're interested in joining a Forbes Council, learn more at forbescouncils.com.